Banks make a lot of money. Today, I'm going to show you how to act just like the bank and make a lot of money. So first off, let's look at what does the bank do. So this is a very, very simple example here, but if you have $10,000 that you put into a savings account at your local bank, if you're lucky, they'll pay you 1%. This is, like I said, a simple example. So $10,000 at 1%, at the end of the year, you're going to end up with $10,100. So you made $100 by parking your money. We all think it's safe. We get that warm fuzzy. It's in the bank. It's my safety net, my just in case, my rainy day. It's there. It makes me feel good. And the bank pays you $100 to do that because, I'll show you, the bank really likes it when you do that. So the bank will then take that $10,000, maybe it's to you, maybe it's to someone else, and say they buy a $20,000 car, someone puts $10,000 down and they get a $10,000 loan. A $10,000 loan, and the bank will give them a car loan right now about 8%, okay? I know some are high, some are low. I'm just a simple example, 8%. So at the end of the year, let's say even you have to pay this back at the end of the year. So at the end of the year, theoretically, it's $10,000 plus $800 in interest that the bank would receive. So the bank at the end of the year made $800. Okay, they've got $10,800. So the bank has $10,800. They pay you back your $10,100. Let's say this is 1 year contract and that's it. And then at the end of the day, the bank made $700 on your money. Now, if you get into fractional reserve banking, the bank can actually loan out, like if you put $10,000 and they can actually loan out $90,000, and they're doing this. So they're making a lot more money than this, but this is just a super simple example. We can't do any of that kind of stuff, but the banks can. So now what if we flip the script and we do exactly what the bank does? So over here, if you have lived in your house for a while and you got some equity and you owe, basically you have $100,000 of equity. What's equity? If you have, your house is worth $500,000 and you only owe $400,000, you have $100,000 of equity. Now, you can get at that equity with a home equity line of credit, not 100% like in that last example, but say that you've got a $500,000 house and you only owe $300,000, you essentially have $200,000 in equity, and say you want to take 50% of that at the 100,000. So here's what you could do. So this would be a better situation. So here you've got $100,000 of home equity that you're gonna borrow from your home equity line of credit, and now the bank will give you that line of credit. Mine, I've got one right now, is at 8%. So that's pretty common. At 8% at the 1 year, say you take the 100,000 out, you have to pay 8% at the end of the 1 year, just like this example. You'll have paid back $108,000 to the bank. So what if you could find a private money deal somewhere and you could invest that $100,000? If you take that $100,000 and invest it at 14%, I'm in one of these right now, at 14%, you're going to make $14,000 at the end of that 1 year. So $114,000, you used the equity of your house, which isn't really your money. Maybe you would own it, you own the house, but you really don't because the bank owns the house. So it's the equity of your house. So you're borrowing the bank's money and you're borrowing the bank's $100,000. You're now going to make $14,000 on that. So at the end of the day, you've got $114,000. 114,000 minus 108,000, you made $6,000 at the end of that year, or 6% on the equity of your house. What does the equity of your house do? It sits there. So many people are trying to pay their house off, and yeah, that's good. Go ahead and pay your house off, but get a line of credit against it. Use that equity to help you. Now, if you did something like this, what if you could do this every year? You make $6,000 every year. In 10 years, that's $60,000. Well, what do you do with this? Do you go on vacation with it? It's up to you. I'm not telling you what to do, but I'm always trying to get ahead in future and keep plowing it to keep growing. So in 10 years, this $60,000, if put back into here, would be worth 60,000, 600? So not that much. So at this point, what I would do, if you know you've got an extra $6,000 of cash flow coming in every year, and maybe you can cash flow from whatever your job or whatever other investments you've got, and you can get more coming in, the more the better. But what I would do is, now with this 6,000, I would start an infinite banking policy. Now with that, the first couple of years, you won't be able to pull as much out as what you put in. But after that, usually around year 4 is where you can actually take more out than what you put in. And again, it's super similar to the home equity line of credit. So now you're going to have cash value of this infinite banking concept that you can pull your money, you can borrow against that money. That money continues to grow and continues to compound. I think the floor is at like 4%, so way better than this, okay? But that over history, they've paid dividends if you get these into the right companies. And there's a handful of companies that they've got to be mutually owned, whole life insurance companies. And right now, the dividend that I'm getting on one of my policies is 6.6%, I believe, 6.64. So if you could take this, put that into an infinite banking policy for 10 years, you keep doing everything here with your home equity line of credit, you borrow it out at the end of the year, you repay 108 and you collect 114. You do nothing different, but you've got 10 years of where you're going to take this $6,000 and you're going to put that into your infinite banking policy. Now, in doing that, now in 10 years, you're going to have way better than 60,000 because this thing is growing and continuously compounding at a much better rate than over here. I don't know what it is. We can always run your numbers. We can run simulations, situations, illustrations, whatever you want to do. But in 10 years, say you might be close to $100,000 again. It's hard telling. But if you could then get close to $100,000, now what you could do is you could borrow against your infinite banking policy the same way you did up here. But guess what? Right now, instead of paying 8% interest, like what the bank charges you, now you borrow from yourself, from your own bank. And right now, the interest rate that I'm paying on mine is 5.6%. So if I can take 5.6% loan, way better than 8%, and I have to repay that back, yes, at 5.6%. But meanwhile, this is always growing at maybe 6 and change percent. So it's growing faster than you're taking off. So there's a spread right then and there, but you're still doing this same situation, except now instead of borrowing the bank's money, you're borrowing your own against your own policy in your own banking system. You can still do this. Why not? Why not still making $6,000 a year? And once you get the infinite banking policy going, maybe you got another $100,000 there, and now you can do 2 of them. If you're making $6,000 from this system with your home equity line of credit, you're probably going to be making, because it's a much lower rate, you'll be making, the spread will be bigger. So whatever the spread was from 8% to 14%, now if we can get this down to 5.6%, it's going to change all the numbers. Your spread, you're going to be way better. You're going to have a lot more money. All right. Again, you've already paid it back. You just got spread left over at the end of the year. Take all that, keep plowing it into something else until you get to the point where I'm sick. I don't want to do this anymore. Or maybe you like doing it, and instead of taking 100% of your spread, you can take a portion of it, take a quarter, take a half of it, and let that go. Go have some fun. Go on vacation. You've earned it. This is what your money has been working hard for the last 10 plus years, and now you can enjoy the fruits of your labor. Okay. So I was talking to someone the other day, and this does take a little bit of time to get up and get going and get off the ground. But you can see from this example, once it does, it's a pretty good thing. So let's just do what the rich entities do, and let's get that spread coming in instead of going out. All right, I hope this helps. Go ahead, and if you want to, you can text Kyle to 855-529-1388. If you ever want to run your own situation, illustration, we can look at all kinds of different stuff. You can pull all kinds of different levers of how you want to do and make this stuff go. So let me know if you got any questions. I hope this helps, and good luck, everybody.